Can Bitcoin's success actually make it more dangerous? The bigger Bitcoin gets, the more catastrophic its market swings could become. On this episode of the TFTC podcast, I sat down with Jessy Gilger, lead advisor at Sound Advisory, who manages over $150 million in Bitcoin assets and brings a decade of traditional finance experience to the crypto space. In today's discussion, we'll examine three central points about Bitcoin's volatility: how nation-state involvement creates larger market risks, why ETFs might be dangerous honeypots, and what historical patterns tell us about future price swings. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. The insights shared in our final segment could fundamentally change how you think about Bitcoin retirement planning. But first, let's dive into why massive institutional players might be setting us up for the biggest market swings we've ever seen.
I don't think volatility goes away. I think we have cycles. The cycles are big, maybe bigger. If you see nation states get rugged, or Coinbase honeypots get seized, or companies with 1% of the Bitcoin, put it up for yield and get rugged by JP Morgan. Like, those are huge. The dominoes are getting bigger, right? Mm-hmm. And there's nothing to me that's proven that the volatility has gone away. And so here's where the bold prediction comes in for the individual, is that sometimes you might be more stable by not being like all in on Bitcoin, right? And being able to, hey, maybe I want a year or two of cash to just ride out a cycle and not have to sell Bitcoin if it goes back down.
Financial advisor Jessy makes an incredibly important point about the evolving landscape of Bitcoin investment risk and how larger players are fundamentally changing market dynamics. In the early days, market movements were primarily driven by retail investors and small institutions. Now, we're seeing major players like nation states and banking giants entering the space, which creates potential for massive market disruptions. When Jessy talks about getting rugged, he's referring to scenarios where large amounts of Bitcoin get seized, stolen, or lost due to poor custody practices or risky financial plays. The significance here cannot be overstated. We're no longer just worried about a crypto exchange getting hacked for a few thousand Bitcoin. We're looking at potential market shocks from entities controlling hundreds of thousands or even millions of Bitcoin. This point directly supports our first argument about how nation-state and institutional involvement creates bigger dominoes that could trigger massive market moves. Jessy's advice about keeping some cash on hand is particularly noteworthy because it acknowledges a reality many Bitcoin maximalists don't want to face. You need to be prepared for massive downswings, especially if you're depending on that money for retirement or daily expenses. The growing size of these institutional players means their mistakes or misfortunes could create ripple effects throughout the entire Bitcoin market, potentially leading to even more volatile price swings than we've seen before. Up next, we'll explore how ETFs are creating dangerous honeypots that could trigger market-wide disruptions, but make sure to stick around until the end to hear Jessy's surprising insights about managing Bitcoin volatility in retirement portfolios.
I see ETFs as a 6102 away, a matter of national security, whatever administration decides, agnostic to that side of things. But hey, we need Bitcoin. Let's go ahead and these ETFs, they'll print the money, make ETF holders whole, quote unquote. But I see that as a huge honeypot. Coinbase specifically running the majority of those ETF funds.
Do you think, multi-institution, multi-sig, Unchained's enterprise offering, do you think that needs to be the standard?
I would love to see a ticker symbol MSIG ETF, right? Mm-hmm. I would really like that, where you've got multiple entities securing an ETF's coins. That would be a better version of an ETF, but ETFs are still Wall Street's layer 2.
Yeah.
Right. They got into the game and they came in right at layer 2. And I know it's a rough analogy, but that's kind of how they're operating. Is you could transfer ETF shares from brokerage account to brokerage account. And all that basis information would actually come with it too, not an on-chain footprint.
The ETF discussion Jessy brings up here is fascinating because it highlights a serious vulnerability in the Bitcoin ecosystem that many people overlook. When he mentions 6102, he's referring to potential government intervention through regulatory actions. The concern isn't just theoretical. We've seen similar interventions in traditional markets during times of crisis. What makes this particularly relevant to our second argument about institutional honeypots is the dangerous concentration of Bitcoin holdings under centralized control. Think about it. Coinbase, as a custodian for multiple ETFs, is becoming what Jessy accurately calls a honeypot. This creates a single point of failure that could affect the entire market. When he talks about the layer 2 comparison, he's pointing out how ETFs create a separate layer of Bitcoin ownership that exists outside the actual Bitcoin network.
Everyone knows about Fold. It's the app where you can earn the most Bitcoin rewards for everyday purchases. Fold now lets you double stack rewards with gift cards. Use your credit or debit card to buy gift cards and earn both credit card rewards and sats. Fold gift cards help you grow your stack with every purchase. If you're not shopping with Fold gift cards, you're leaving sats on the table. Get a 20,000 sat welcome bonus. Go sign up now at foldapp.com/Marty.
This separation from the base layer introduces new risks and potential sources of volatility. The ability to transfer ETF shares between brokerages without touching the underlying Bitcoin might seem convenient, but it's creating a parallel system that could be vulnerable to manipulation or systemic problems. This perfectly illustrates our concerns about ETFs creating potential for larger market disruptions. Not only are the players getting bigger, but the structures they're building introduce new forms of risk that could lead to sudden market movements. This concentration of Bitcoin under centralized control goes against the core principle of Bitcoin's decentralized nature, and it's creating potential pressure points that could trigger significant market events. Now, as we move into our final segment about historical volatility patterns, Jessy's going to share some eye-opening insights about what this means for Bitcoin's future price stability. But first, let's understand why these patterns suggest volatility isn't going anywhere.
With the volatility, right? So 50% CAGR with a 80 vol. It's a beast. I have several clients retiring this year, and we look at, well, how do you stay retired, right? We don't want to go. These clients don't have a goal to go back to work. And if cycles continue, you want to ride 70, 80% down again. So it becomes a discussion. How do you balance this? Because you might have the 50% CAGR, but you might have the 80 vol associated with that. Both those might compress, you know. I think as adoption grows, and if Bitcoin is money, then in a future state, it should be stable. Like, you can imagine very little volatility.
Yeah.
When Jessy discusses the relationship between returns and volatility, he's touching on a fundamental challenge that solidifies our thesis about Bitcoin's persistent volatility. He mentions a 50% CAGR, that's compound annual growth rate, alongside 80 vol, which refers to 80% volatility. These aren't just abstract numbers. They represent the real-world tension between Bitcoin's incredible growth potential and its wild price swings. This directly supports our third argument about historical volatility patterns showing no signs of decreasing despite increased adoption. For anyone helping clients plan for retirement, this creates a unique challenge that's unprecedented in financial planning. Traditional investment planning typically assumes relatively stable assets that might move 10 to 20% in a year. But with Bitcoin, we're talking about potential drops of 70 to 80%, even while the long-term trend has been dramatically upward. Having worked with quite a few entrepreneurs at 1031 Ventures who are trying to navigate these waters, I can tell you firsthand that managing this volatility while maintaining enough exposure to capture Bitcoin's upside potential is one of the trickiest balancing acts in modern finance. Even as Jessy notes the possibility of Bitcoin becoming more stable in some hypothetical future where it's widely adopted as money, he's acknowledging that we're nowhere near that point yet. This is particularly crucial for anyone thinking about retirement planning or long-term wealth preservation. The reality is that Bitcoin's volatility isn't just a temporary phase. It's a fundamental feature of an emerging, revolutionary monetary technology that's still finding its place in the global financial system. As Jessy points out, this persistent volatility means you need to think carefully about your personal situation and risk tolerance, rather than simply following the all-in approach that some Bitcoin advocates recommend. The historical data shows that despite growing institutional adoption and market maturity, Bitcoin's price swings haven't become any less severe. If anything, they may be amplified by the larger players and structures we discussed earlier. How will you protect your Bitcoin portfolio from these growing institutional risks? Let me know in the comments. I read every single one. And if you found these volatility insights interesting, you'll want to watch our analysis of Bitcoin tax optimization strategies. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble, stack sats,